In this video, I'm going to talk about differences between international accounting standards and U.S. accounting standards when it comes to accounting for inventory. Let's start with cost flow assumptions. U.S. GAAP allows companies to use LIFO, which is last in, first out, whereas IFRS does not. A company that's reporting its financial statements according to IFRS cannot use LIFO as their inventory cost flow assumption. Why does this matter? Well, let's say you're comparing two grocery stores and you've got one that's reporting according to US GAAP and the other one is reporting according to IFRS. If the one that's reporting to US GAAP is using LIFO and then the one that's using IFRS is using FIFO, you're going to have differences in the profitability of each company that don't have to do necessarily with the company's actual report or profitability, but have to do with the cost flow assumption. Remember, in periods of rising prices, LIFO leads to lower profitability, whereas FIFO would result in higher profitability. So if you're comparing two firms and they use different accounting standards, you want to make sure you see that, okay, I'm comparing apples to apples. Now, another difference between IFRS and US GAAP is when it comes to inventory write-downs. So for IFRS, all companies have to use the lower-of-cost-or-net-realizable-value method. Basically, inventory goes on the balance sheet at cost, right, when you initially get the inventory, but then you compare it to the net realizable value, which is the expected selling price minus any cost to complete the sale. And whichever is lower, that is what it's going to be reported on the balance sheet, okay? So if net realizable value is lower than cost, you'd have a write-down. US GAAP is similar, okay, in that most companies also have a lower cost or net realizable value rule. However, there's an exception. For companies that use LIFO or that use the retail inventory method, they instead use the lower of cost or market rule, okay? And that's a little more complicated to calculate. I've got a video on that, but basically in the US, it is not that all companies just use lower cost or net realizable value. That's how IFRS is. So if you're looking at financial statements, they're prepared according to international accounting standards, and the company has inventory, you know they're going to be using lower cost or net realizable value to decide whether there's going to be a write-down. Whereas with U.S. company, we're talking about U.S. GAAP, it depends, okay? If the company is using, let's say they use FIFO or average cost, then they're going to use lower cost or net realizable value. But if they use LIFO or retail inventory method, you're going to do lower cost or market, okay? Also, with respect to write-downs, with IFRS, when a company has, let's say they wrote down the inventory by $800. Now, let's say the next period we say, oh, wow, actually, we haven't sold the inventory yet. And that write-down that we took before, actually, the inventory has recovered some of its value or maybe all of its value. And we say, well, can we reverse this? Can we say, you know what, let's go back. Let's make a journal entry to undo the write-down that we previously took. Under IFRS, yes. You can reverse a write-down that you previously took if you haven't sold the inventory yet and the inventory has recovered its value. However, you cannot do that according to US GAAP. Under US GAAP, you can write inventory down, but you cannot write it back up. Even if you know and you say, well, look, actually, you know, the value of this inventory has increased and we wouldn't have taken a write-down if we knew what we knew today. Well, it's too late. You have already made the write-down and you can't go and reverse it per US GAAP.